Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yeah. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do or just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And
Alrighty.
I'm going to share my screen. While I'm doing that, for anyone joining us for the first time, Will and I, we do this show in the morning to help answer questions you have about the Market Chameleon tools, the data, analytics. If you want to come on the show and ask your question live, we do provide a link to Zoom on that live chat on YouTube. Click on that, takes you over to Zoom. Once you're in Zoom, click on raise your hand. You could ask your question directly. If you prefer to type your question, you can also type your question into that live chat on YouTube. Will's watching that and he'll read those questions back to me. So while we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report to see if we could get some insights on what's going on in the pre-market hours, and then we'll move on to the questions. Okay.
Perfect.
Pre-market report. These are stocks that are trading in pre-market hours today. I'm going to scroll down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see 43 stocks so far made our percentage gainers list, 130 on our decliners. So right now, from this perspective, we look like we're set up for a bearish bias at the open. I'm going to scroll up here. And we're also going to take a look at this calendar view, which is sectioned off by a summary of what's going on from a high level in pre-markets, by calendar day. So you could go back in time. But right now, we're on August 15th. And this is what's going on so far. 215 stocks are trading in a pre-market that are higher than previous day's close, yesterday's close. 540 stocks are trading lower. As far as the volume of shares, 84.3 million shares are trading on up volume or 65.2 million on down volume. But if we convert those shares to dollar value, since not every stock price is the same price, there was $1 billion worth of stock traded on up volume versus $2.4 billion on down. So, this still kind of indicates a bearish sentiment setting up in the pre-market hours. One more check we could do is come down to this list. And if we see this list has a lot of stocks in there that are small cap stocks, it could be a preferred stock, an ETF, a leverage product. Really anything that's listed on a major US exchange, if it's trading in pre-market hours and meets our thresholds, volume, price, the way it's trading in pre-market hours, it can make this list. So to narrow down, you can use the filters above. And if you do have a watch list and it's saved, you can filter by your watch list. Just drop it down and select your watch list. We're going to use this filter in ETF. I'm going to click on that, get a list of ETFs to choose from. And the top one, SPY, that's the S&P 500 ETF. I'm going to select that. And when you do that, the list below will get filtered by stocks that are holdings in the SPY ETF. And here we see 2 stocks made our percentage gainers list. There are 22 in the decliners. And this also indicates right now we're looking like we're setting up for bearish bias in the pre-market hours. So we did give it a couple minutes. If you have questions,
we did have one question pop up, D. It's a request to look at a strike I guess Michael Burry from The Big Short, and I did check the news. It was in the news on a recent regulatory filing about his Scion Capital.
Mm-hmm.
Had a big position in the Jan 24 720 strike puts in SPY. Ronald was just looking, do those puts look any different than any other puts? I guess he just wanted to see if you could take a look at
Which put?
it was the Jan 24 SPY 720 strike.
720 strike? You sure it was
Can't
a SPY?
You know what? Could that be the future?
Yeah,
That's probably the future.
I mean, that seems like very, I could look, but
That wouldn't even make sense if he
yeah,
was buying a put.
yeah. I don't think, it would be an SPY. I mean, here's a Jan 2024. This one, 720 strike. So I'll take a look at the open interest. I mean, there's 88 open interest there, so I doubt it, but it's an interesting. So you see that trade 626.
So he bought it deep in. If that's him, he would have bought it deep in the money put, basically, rather than
right. So if that's his put, maybe it is, right? Maybe that is his put. I don't know. We could see there are 88 puts that have open interest on that 720 strike, Jan 19th. All right.
They said it's a notional value of 886 million against the Spider 500 ETF. That's the notional value of the bet.
I don't think then this is it.
Yeah.
Yeah.
I mean, I'm just reading, trying to read an article that popped up, but
I don't think this is right. But whoever's holding this put is making a mistake because it's a candidate for an early exercise. I'm going to get into that. I'm going to do a whole webinar on there, but essentially, that you could see there's no open interest anywhere in between here. So here's another one. So somebody holding this put is holding a short position, but I don't know if I have time for this right now, but I could tell right from there.
They're missing the dividend, right?
Well, not
the carry cost,
the carrying cost of it, right? Yeah. So by holding on to that put, they're basically missing out on the interest they would earn on that short. So like this is actually probably a mistake because they could have had the same risk exposure to the downside, but saved themselves a bunch of money with the interest carry. So I could tell right away, but I don't think this would be the put that they're referencing, because that wouldn't be the notional value of it. I don't think. Let's see how much the notional value of this put would be. So we have 88 times, let's say 271. So this would be like what, 2.4 million, something like that.
Yeah, and obviously we've talked about these regulatory filings before. I mean, these are the position, and they do say it in the article, right? He could be out of the positions. You don't even know.
You don't even know, or it could be a hedge against a long position too that he's correlating. I don't think this would be his put because, number one, he understands options. Okay, he understands how options work, how options are priced, and this is not an option that a professional would be carrying because you're better off already just shorting the stock than holding on to that put. So
yeah, SPY's got a big enough float. You're not worried about.
Right. Or you could just do a different way. You could do a different put that, you're not foregoing that much interest. So I don't think that's his put. I would be really shocked and probably surprised if that was the case. But it must be a different put that they're talking about. And that wouldn't be this, it wouldn't be the notional value of, what they describe.
Yeah, well, they don't, in the article I have, they don't describe the actual put or the expiration. They just said the notional. So,
Yeah. So I don't believe that this is it. Well, I mean, was there another?
that was it.
Yeah. Okay. All right. So, take a look at any other questions there.
None have popped up now.
All right. So I'll quickly just kind of go over them. Why does anybody know why would this be an early exercise then? Does anybody curious about that? We could go over that as well.
Well, Rob did ask, why would they buy a deep in the money put as opposed to an at the money put?
Right. And the at the money put would have also time premium in it, right? So this one probably doesn't have any more time premium left in it, but it has a cost of carry. So if you bought an at the money put, if for $15, let's say, or whatever this is, $13.50, if the stock just sits there, right? If it just sits there, that put will start decaying. Implied volatility could come in, and then what will happen is you could lose that premium. So you do have vega and time premium risk in it, right? So you do have that vega and time premium risk. But if we go all the way here to the deep in the money, so what's happening here, right, is basically you're just short SPY, right? You're 1-for-1. So there's no real decay in the option, but if the stock goes up $1, $2, then this put will lose $1, $2, 1-for-1, right? If the stock goes down, then this will $1. This should go also up $1 because you're short, right? This put has a 100 delta, so it's going to move 1-for-1. So it's like being short a stock. So if your risk profile is being shortest here, I'll bring it up here. Here's what it looks like, right? This put. See here? It's just like being shortest stock. So the stock is right here. So if the stock goes down, you're going to make money on the put. If the stock goes up, you're going to lose money on the put, but 1-for-1, just like you would in a stock. That's your delta, right? Let's say 100. Well, but by holding on to that put, right? Holding on to the put, there's an opportunity cost, because you could achieve this by being short the stock, right? You could just sell SPY short and have this risk profile, right? This would be your risk profile if you shorted the stock, so it'd be equivalent. But what happens when you short a stock? Well, when you short a stock, you borrow a stock from somebody else, you sell it, right? You sell it short, but when you sell it short, money comes into your account, right? Because you actually sold the stock for cash, right? For dollars, right? You exchange the stock for dollars. So now you have dollars sitting in your account, and you promise to buy that stock back later on that you borrowed and give the stock back. But now you have dollars in your account, and what do those dollars do in your account? Well, they earn interest, right? Hopefully your broker pays you interest. If not, you could buy the treasury that pays interest, right? So let's just say you could buy treasury at 5%, 5.5%. Well, that's real interest that you're earning, right? So if you sell 1,000 shares of SPY, for $448,000, and you're earning, 5.4% interest, well, that's real, right? That's real money that's adding up over the course of a year, or even on a monthly basis. So once you short a stock and that money earns interest, but let's look on the flip side. What if you're not shorting the stock, you choose to be short by being long a deep in a money put? Well, what's happening here is that if you're long a deep in the money put for $272, right? Well, not only aren't you earning interest on anything, but now you have to take $272 out of your bank account to buy these puts. So that money that you're earning interest on, now you bought these puts that now you're no longer earning interest on them, right? So, or you had to borrow money to buy these puts, so then you're paying interest. So what's happening is, instead of earning interest on your short, you're foregoing that amount, plus you're foregoing or the opportunity that you were earning on your cash. Now you bought these puts. So it's like a double whammy, right? So what's happening is that the person who's sitting on this short either does not know what he's doing, has a really bad risk management system, or like completely forgot, but that is a mistake, right? Because now you got these 80, and you see this 626 volume, that's a market maker and a hedge fund that spotted this mistake, and they're trading it against each other because they want to siphon off that open interest. Because what do they want to do? They want to be short the put and short the stock and earn interest. So this is here somebody exploiting this mistake.
They're hoping those don't get exercised.
They hope this don't get exercised, because the other side of it is short the put. That means money's coming in, and they're short stock to hedge against it. So that's money coming in, and they're sitting there and earning interest at 5.5% weight, on a hedged position, right? So this here is an example of a bad risk management system that is just leaking unnecessary money. This is just like, you're just basically just giving it away. Now, I don't know if somebody just forgot and doesn't have a risk management system in place, doesn't know how to calculate the cost of carry, but this happens sometimes, and there are other people who will try to exploit that, right? So you could see here, it's not like open interest is not coming up. It's just two market makers trading it between themselves because they want the opposite position on.
And this happened a lot back during the internet boom, and the classic one was Yahoo. Mark Cuban had a big Yahoo position when he sold his company, and he immediately through Goldman went out and did what became really deep puts, and he never actually, he just let him go to the end basically, and that that market makers on the floor were constantly doing this trade to capture the interest.
Right. So the risk management is actually, I'm doing it on, I'm writing up like the different components right now that you need, and risk management's one of them. And try to release it to you so you have like these, at least like a roadmap or guideline. But it's important because it seems like, well, what's the big deal, so you don't earn the interest. But if you're going to be successful in this business, that's a big, you need to be that efficient, right? If you're that inefficient, it's going to be, because then you're really relying on luck and not efficiency, right? Your system should be efficient, being able to spot these opportunities, be able to avoid these types of losses, or otherwise your system is not good, right? Your system is not good, and eventually you're going to fail. But it's, when we talk about trading, I think some people's imagination, well, trading is trying to find things that are going to go up 1,000% or 500%. That's not trading. Trading is trying to beat the risk-free rate and beat the market, or outperform the market. Okay, that's what a trading system does. If you could do that, then your trading system could make a lot of money, because then what you're doing is scale, right? It's the difference between what you could make and where you could borrow, right? What you could make and where you could borrow to finance what you could make. That's your trading system. It's not finding things that are going to make you a 5,000% returns or 2,000% returns. Your trading system needs to have returns that are beating the risk-free rate, and then beating or doing better than the market, while lowering the volatility of those returns of the market. That's what you're trying to do. Okay. So that's where your focus should be. Because if you could do that, then if you could make 8, 9, 10% returns with low volatility, that means which are better than the market, that means you're going to be able to finance it. If you could finance that trade from 5, 6%, then you're making the spread, right? That's how it works. Can you create a strategy, a system with reduced volatility, reduced risk, that can make a spread between where you could borrow money and where you could, lend it or employ it into a strategy? All right. So it's very important. That's why these things that I'm showing you here, these really matter, because there's somebody here right now, their entire strategy. You see this strategy here, the market makers that are doing this, exploiting this adds up to millions of dollars every year. Every year, people are making millions of dollars just exploiting this strategy alone, because somebody has a very bad risk management system. Okay, so it's a good thing that maybe you read that and we're able to at least spot this situation.
Yeah, no, that's great. The Chameleons were very thankful and love your depth on this topic and the discussion. Rob did ask this type of Rob, please ask Dimitri if you can use calendar spreads on long dated puts or calls to offset the cost of carry.
So, okay, the answer is yes, that there's an offset, right? If you're doing a calendar spread, that spread, the spreads offset some of your risks. But in this situation here, it would still be an early exercise. So you're not going to offset, because if you sold a deep in the money put somewhere else, somebody's going to exercise, right? So they're going to exercise. So you're going to be left with long stock, long put. So in this situation, it's an early exercise. Like the best thing to do here, the rational thing to do, is to exercise that put, unless there's some kind of corporate action that could justify it, but in SPY, I don't know of any corporate action that could justify it. Sometimes you could justify it because there's a corporate action. And if there's a corporate action, let's say that splits off the stock or has like some kind of special, I don't know, breakup of some kind of cash with this, then maybe you have to reprice it using the terms of that corporate action. So there's sometimes where you want to hold on to the put because it lets you hold on to the stock, right? If you need to own the stock, but you don't want to be exposed to the fluctuations of this, the stock price, you could own the deep in the money put and own the stock because you're anticipating to convert that stock into something of more value, right? If some kind of at the end of a corporate action. But in this situation, somebody's just sitting short, wants to short it. That's what it looks like. Somebody wants to be short SPY and has that put. And I can't think of a reason why you would want to own this put when you could just, there are, other ways to be short this than owning this put and not having to forgo, because that's a big opportunity cost. So I can't think of why why do you want to sit on this? It doesn't make any sense to me. You guys could calculate the interest on it. I'm sure it adds up to a pretty good amount. So this, whoever's sitting on here, what did I calculate? $2.4 million worth of just options alone, and then you got another, whatever, it'll calculate the price of the stock, whatever you shorted, it's gonna add up. All right, so if there are no other questions, Will, I'm gonna probably just stop right there.
All right, perfect, D. Awesome job, my friend. Thank you so much.
Yep. All right, thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you gung tomorrow.
All right, Trade and Peace Chameleons. Thanks for the questions. Great job, D. Have
Bye.
a great day, everyone. Bye.